This is Billy and Shaun, Peterson Wealth Services, Point of View. Today, we're going to talk about the markets, about the most recent Fed rate cut, about potential recessions that are still looming. Of course, a lot of economists are still very highly concerned about recessions, the fears that are boiling up, and of course, valuations. We haven't seen valuations this high in quite some time. So it's important for us to share our thoughts on these markets, the conditions of the markets, the investments that we're making for our clients, and why we're doing what we're doing. So start right in here with the price to earnings ratios. I think this tells a lot.
Yeah, I mean it's a conversation that comes up all the time, I think, when markets hit all-time highs, like we've been doing here over the past few weeks. And we didn't really think we'd be telling people in reviews how well they've done this year, the way the year started, right? With
Most people are getting numb to this, Shaun. Oh,
I think so.
20%?
Yeah.
Yeah, big deal.
Yeah. So a conversation that always comes from this are market valuations. And the way that we value markets, just one metric is a PE ratio. So it's a price to earnings ratio. And basically what that means, you can look at it on an individual stock basis, or you can do it on a index like the S&P 500 index. And what it's saying is our latest read, and this is a forward, so this is forward looking, so estimates are involved here. Our forward PE is 22.4 times earnings. What that means is you're willing, for every dollar of earnings, you're willing to pay $22.50, let's call it. On average, we've seen about a 16 historical forward PE for the S&P 500, and that's a good gauge. That's 500 of the largest US companies. It's an index that's reported daily on the news, as you know. And we're kind of looking at this chart and saying, let's compare that. So when we had the tech bubble, which I know Billy lived through, you see these gray hairs? He earned those. Part of that's from the tech bubble, I'm sure.
Yeah, I got a few of them starting right then. I see you got a few right
I've
now
got a
too.
patch coming in. I don't know. It wasn't tech bubble, maybe financial crisis, but mostly my kids, I think. So back then, the S&P was trading at a forward P of 24 and a half. Now we're sitting at about 22 and a half. So it's begging the question of, are we overvalued at this point?
Yeah, that's really a question that we ponder quite a bit. Now, interestingly, I point out this financial crisis low back in 2009. That was, you look at that and you think 9.5 times earnings. Well, that was so cheap. Why didn't everybody just jump in with both feet back then? Let me tell you why, because back then they didn't report the PE ratios at 9.5 times earnings. They were reporting them in the mid to high teens because earnings expectations were way off base. You know, when markets are going down and the economy looks terrible, expectations also become terrible.
Lower.
So they're lower and now looking backwards, we can get that rear view mirror and say, oh, earnings actually were getting ready to accelerate and take off. So therefore, stocks were very cheap. That's why it's so difficult because there's no bell that rings. There's no instant data that tells you what's going to happen going forward. It's all an expectation. So you have to either believe in these businesses and the companies and where they're headed and give them the ability to make decisions, which is the toughest thing that we try to tell clients. The toughest thing to do is to buy when no one wants to buy.
Exactly. And just because we're hitting some higher valuations, that doesn't mean we're on here saying markets are going to drop, get ready. We're just trying to talk through this and we're looking at all different sectors. And there's no perfect PE ratio. It's going to vary on index, it's going to vary on individual sectors of the market. So we're just kind of pointing out, hey, we're seeing some things where maybe it is a little bit stretched. So if we saw a drop or a correction, it would not surprise us. Also, it brings up an interesting point of we're looking at US companies. International companies have underperformed. I think, did they come back? They were outperforming US.
This year they are.
This year they still are, but it's been a 15-year or longer underperformance of international companies. So we are talking as we're making portfolio decisions about maybe allocating some more dollars in those areas. So it's a great chart, very simple to understand. Let's jump to this next one. Billy's going to tackle some points here on.
Yeah, so going back to the chart we just talked about is some people might say, well, it's getting to the point where the PEs are stretched. why don't you just sell everything?
Mhm.
Oh, I mean, easy, right? Snap your fingers, bam, we're going to cash.
Chips are off the table,
Yeah,
boss. Here comes the
guys,
pit boss.
back home, we're done. But that's not the way investing works, guys. It's not like you can sell your house when the valuation gets higher, sell your private business and say, I'll get back in, I'll buy it back when I feel like it's a better value. That's not how this works. Plus, you have to consider Uncle Sam. He's going to have his hand out to take a huge chunk of your chips that you just pulled off the table, is Shaun's analogy. We want to make sure that we're thinking about it long term and strategically, and getting out and getting in is not as easy as it sounds, because no one knows where the peak is going to be. It could go, let's say, for example, the S&P goes up another 100% from here. And if you buy into this theory that the markets are too expensive, you're sitting there watching all that from the sidelines. Not a fun place to be.
No.
This chart will tell you that story in a couple of different ways. This goes back to 1928. And so we have this whole period throughout the US history. And it's amazing to see what we've gone through as a country. From the crash of 29 to the Great Depression, World War II, and how tragic things played out back then, not only for the loss of life, but businesses and the depression that brought about all of those things. Vietnam War, you had the stagflation of the 1970s, which was an interesting time frame because there's some similarities to today's day and age with stagflation being a concern. That just means that there's inflation, but a stagnant economy. So we're not growing, and the Fed can't do a heck of a lot about it to bail us out of that situation. Of course, you had all these other issues, from the tech bubble to the financial crisis to the housing bubble to the pandemic, trade wars, with tariffs. And of course, we've heard most recently about Trump's, and especially from one side of the aisle, Trump's tariff policies are going to kill I mean, how many times did we have to hear that repeated broken record that we're going into a deep, dark recession because of Trump and the tariffs? And we've had to say that, look, this is a businessman. Of course, you may not agree. Everybody's not going to agree with his strategies, but it's worked out pretty well so far.
Yeah. What's interesting is the bottom half of this chart. So what it highlights is all the events that you just talked about and the drawdowns that were experienced there. And so that can feel like an extreme point in time. But if you look long term, you can see the growth of, let's call it the US companies, capitalism, everything at work there. So the other thing that we always talk about, and if you watch any of our podcast or listen to our podcasts or watch any of our videos, is how intense the media can make these events feel. And it can make investors lose their minds almost, right? We've seen that. And you've got to fall back to being diversified, looking at the good companies or funds that you own, and then leaning on your financial plan that's considered drops, that's already played that out and showing that you're still going to be okay.
And to back that up, that point about the media, I would dare say, from my experience being in this industry, that the media causes about twice as much damage as is necessary. So, for example, the fundamental drop with business valuations could be, let's say, 50%. Let's say back in the Great Depression, 1932. But the media piles on, and then everybody seems to think they need to panic and do something about it, and the media makes it far worse. And that's throughout history. I don't care the pandemic. Any time in history, if you want to look at it, and people got sucked into the news story of the day, and they just promote catastrophe.
Right.
They love it.
And you go back to like Great Depression era, World War II, it wasn't, we had radio, right? And we had newspapers. Billy loves his newspaper, and I'm proud of him for that.
We should bring
he still reads it.
Bring him back. It's a revival.
But contrast that with what we have now. We've got these things that are going off every 5 minutes, and the news flow is nonstop. You don't know if it's real or not. Things are taken out of context, and it's always in front of us. So it makes it even, I think, more intense than, in the earlier years of the United States.
The drops are more intense. They're more severe. Also, the recoveries are quicker, I think. So
right.
The market's recover.
Maybe there's a positive to that.
Information travels so much faster. I think it's a good and a bad. The trade-offs are social media is horrible in society. I think that there's far more negatives than positives that come out of it. Just
Yeah.
with people getting on there thinking that they have a voice and they need to be loud and they need to tell everybody what they think. My advice for people out there listening is be very, very leery of any social media, especially these influencers who are peddling their story. Uh, they're scammers out there all over the place, getting you to try to buy into whatever they're selling, a newsletter. But many times it's based on a fear tactic of the world's coming to an end and this is going to happen. And this guy predicted this last time. So he's going to predict the next great recession. And this is the only way to protect yourself. And we're going to talk about that in a minute. But like the fear trades,
Yeah.
you know, run to the hills, get gold, get your food storage, and I'm not saying that don't be aware of things that can go wrong in protecting yourself and your family, but don't buy into the constant scam of the fear on social media. There's mostly political hacks on there as well.
And financial hacks.
Financial hacks have no education or qualifications to be telling people what they're telling them. It's embarrassing to me to be in this industry and to look at some of these social media buffoons on there telling people how to invest and what to do. You know, they're all over on Reddit. They're doing their thing. They've got the TikTok moves. They got their little videos that they put out on a minute by minute basis. But let's go back to the staying invested, kind of getting away from the media. And the way you stay invested, first and foremost, is you stop listening to everybody. Stop listening to all the media, the market timers, and you just realize that there's a strategy that's worked, and it's worked for hundreds of years by getting in the boat and staying in the boat and knowing that hey, that's a solid path that you're on. You have a plan. You don't necessarily need to change direction every time, and you certainly don't need to try to grab a life jacket and jump overboard. But what we're trying to say here is staying invested works. And this chart shows you over the past 25 years, so a smaller sample size, but 25 years is still a long period of time to most people. And it says, all right, if we had experienced a 2% market drop or worse in the market on any given day, what would have happened if you took action? So if you decided to get out for just 1 week, and then we tallied up the numbers after a 25-year period, this chart just shows the balance of $1,000 invested. But let's take that out to a more significant and more realistic number that people relate to. Let's say it's $100,000. So the 1 week you got out, now 25 years later, you have $317,000. And if you got out for 2 weeks, you have $300,500. If you had 1 month you got out of the market, you're basically cut in half, $262,000. And if you got out for a full year, now you just have a 24-year investment period after that worst 2% drawdown. Okay, 140 grand. That's 100,000. You made 40 grand in 25 years. That's some people would say that's great. That's not good.
No.
Because the person that stayed in the boat is now walking around with $556,000. And that's just the S&P. All right. That's just not ever investing again. That's just staying in the boat, never touching it again. That's important in our opinion. So you can't predict market drawdowns, market corrections, market rallies. And these big moves are typically followed by equally big directional changes. So a drop will be followed by a gain.
Yeah. The best days are usually right after the worst days. And this chart goes back to, and I think it helps reiterate our values and our principles when it comes to managing money on behalf of our clients. We're not willing to take the risk of going in and out for clients. Do we make adjustments? Absolutely. We need to be forward looking, but it's never, like I've used before, chips on or chips off the table for a gambling term. Just not prudent in our opinion. I want to jump forward and take a look at this one. Again, it talks about the value of staying invested. So, you know, the initial investment, we're talking about $100,000 made right after the tech bubble. You're moving along here, and then bam, this gray bar represents a market. I hate the term crash. I wish they would change this, but it was a financial crisis.
The media
whatever.
gave it that term,
Yeah,
Shaun.
the crash.
Thank the media.
I love hearing people or seeing them. The market's gonna crash. Okay, well, what does that mean? Anyways, we went through a economic slowdown with the housing crisis, everything like that, and your value dropped pretty significantly, probably below where you started. And it shows what happens if the investor is a buy and hold, so they just stayed put through this, and then their ending value today. So over $1.1 million versus the person that said, you know what? I'm going to sit this out. I'm going to move to the sideline. So that's cash for 1 year and then get back in. $715,000. That's a 400 and something $1,000 difference. Or the person that moved to cash. And this is what I hear a lot of times is in 08, 09, I lost everything.
Everything.
Which means they moved to cash and they took a hit on their investments. Very few people lost everything. And the ones that did were not being prudent. They were tied up in real estate. They were all in one company. They weren't diversified. They sold. So when everything, I put it in quotes. But anyways, let's say you moved to cash. You never got back in. And people that moved to cash, most of them didn't get back in. And the reason being is they needed to get back in when the markets were worse to make this make sense. And they couldn't do it. Emotionally could not do it. So they moved to cash and now they only have 151,000. So that's $1 million difference versus the person that just stayed put.
A much different retirement. It's
Oh,
not
way
even, you
different.
can't
Think about
retire on
that.
that 150. And it's interesting because this is very, very true. It's very logical for people to look at this and say, wow, what would I have done in that? You don't know what you would have done if you didn't live through it, because the experience comes at you pretty hard and pretty quickly. And I've been talking about it all through this episode. The media stirs you up to a point where your emotions take over. And I've represented clients all the way through this. So I started in this business in 1996. I saw that. And actually, I've actually worked with clients who did all three of those things.
Sure.
And, the things that they do in the market, in the moment, that's what matters. It's in the heat of the moment what you do. Because I've even had clients who did one step better and they invested in that.
Yeah, I wish they had that
drawdown.
scenario.
If they
up
had
there.
that chart or that number, it's probably off the chart here. Because if you can go in when everybody's going out, if you have that fortitude and that foresight and that conviction, and honestly, that's what's made the difference for me. And I know you guys, and the things that I always believed in is a going contrarian, to go against the herd, to not be the sheep.
Yeah.
Never be the sheep.
Let me ask you something. Your clients that stayed put are the ones that bought. I mean, this may be hard to put a percentage on, but, and I'm going to let you brag a little bit. How many of them would have done that had they not had you as an advisor?
I hate to, it's speculation here, but I think 1 or 2%.
I agree with you. And the reason I bring that up is because there's so many do-it-yourselfers now that want to be out there and think they can handle this and everything's going good. My question is, what do they do when they go through something like that? And I feel like that's the value add. You can see the value add between the person that maybe doesn't have an advisor and one that does and talks, and a good advisor, because there's bad advisors out there too. But it's $1 million difference. Is that worth it? Is that worth having someone on your side to guide you through that? I would say yes.
Mm-hmm.
All right, couple more charts here, and then we'll wrap things up. But
I think this one's really important to show people perspective, because if you see a decline in value of your investment, then you need to understand that it's not the same percentage, not the same number that you need in increase to get back to even. And the easiest way for me to explain this one is to take the 50% drop, because you got to think about this from a standpoint of where percentages are. If you had $100,000 and you lost 50% of it, or it dropped by 50%, okay, now you're at 50,000.
right.
So it's pretty easy math if you stop for a second and think and say, ooh, for me to get from 50 to 100, that's not a 50% gain. That's 100% gain.
Right.
So I need to get 100% return on my money just to get back to even. Now think about that. Will the market get back to even typically if it falls by 50%? Has it ever not?
It always has.
It's never not. So I've said to my clients in the past, you've dropped by 50%. For it to get back to even, it's got to go 100%. Do you want to double your money? How about when we invest right now? Would you like to think about, even if you just got back to even, you're now making 100% on the new money. Now, the other way to think about it is be careful with speculation and things that are crazy.
Or stock concentration.
Stock concentration, one stock, things that don't have earnings. I remember back in the tech bubble when I was in this business early in my career, and you'd see some of these companies with zero earnings, no earnings at all, but just a hope and a plan or a thought about what they were going to sell because the internet was new. I mean, remember, there was no internet. There was no connection to people around the world on computers and things like that. That was like not even thought about yet. That was imaginary in my mind. But all these companies were now, the internet was coming into fruition and people were now wanting to sell things to people from the internet, from a website. But many of these dropped by 70, 80, 90% when the kind of tide went out and you kind of realize, well, these guys have nothing behind them. There's no financial stability at all. Their lending is drying up. The banks are running away from them. Their capital is basically depleting. And everybody's saying, holy cow, get me out of this stock. And nobody's buying it. Everybody's selling it.
Yeah.
And when we drop 70%, guys, the numbers right here on your screen, you've got to increase that now by 233% to get back to even. So be careful with what you're doing on speculation and things that have no business trading where they're at right now. I can't tell you which stocks could drop by that. And on individual basis, I could pick out the ones I think might have the most likely chance to drop by that much. But I would rather stay with a basket and diversified into different industries, because I remember the tech bubble, the whole damn basket, if you took it all together collectively, dropped by 80%.
That's nuts.
Because that was how you had so many internet stocks in that basket that had no earnings or business to be even a legit company. And they were going IPOs. They were coming public on a weekly basis. Another dozen companies. Here's another dozen. People were jumping over top of one another to get their hands on these shares that had no earnings.
I keep giggling because I'm thinking of the Wolf of Wall Street scene.
Yeah.
Where Leonardo DiCaprio calls up a random person, is like, something just came across my desk, John. And he's pitching a company like you're talking about.
We haven't seen anything like this
ever
in the history.
And then they flash over to the company and it's like two dudes in a garage and the mom's the secretary, like no business being an investment for someone. That's why I'm giggling through this, but that's what you lived through.
It's very true, because so many of those businesses
and that
dropped and never came back. They went out of business.
And that, we talked about valuations at the start of this. Yes, maybe they're a little bit high, but at least there's earnings to back up some of these valuations. The question is, when does it become too far overvalued, and can the earnings keep up? And that's our job. That's what we're doing, is we're constructing models and different strategies for clients. So I feel more comfortable, I guess, is what I'm saying, when we're seeing a little bit of stretch valuations for the type of companies we're looking at versus a shed in the back of someone's garage or home.
It's a much different environment.
Much different.
Earnings right now, there's established earnings, and this is a different environment than what I lived through in the tech bubble.
Tell me about gold, Billy. Everyone's talking about gold now, all-time highs.
So gold has always been around. It's something that gives people this comfort, this feeling of comfort. Sean likes gold because he gets to put it on his watches. And
I'm a watch collector. Settle down.
Watches.
It's not an investment for me.
He thinks it is, but
I like
but
them.
that's a different subject. What I look at when I'm talking about gold is, what is the utility? What does it do for us? All right. So gold has somehow throughout history and throughout mankind becomes this sort of an asset, or it's viewed as an asset that people want. They believe it's something that stores value that they can use to trade for something else.
They don't make any more of it, Billy.
That's right. They can make it. So, I mean, I don't know how much more is out there. We might find a huge reservoir of gold somewhere at some point. But anyway, the idea here with gold is it's a defensive characteristic. It provides you some sense of peace and comfort when the world's really shaky and volatile and no one trusts anything, especially when they don't trust the currency that we're exposed to, the US dollar. You hear all kinds of stuff going on right now. The US dollar is in the toilet. It's never coming out. The Federal Reserve is terrible, which, by the way, I tend to agree with. Federal Reserve has been absolute dismal for the last. Oh, it's horrible. So late to the party, so wrong on so many fronts, telling us all the time that it was a transitional inflation back when when the government was printing money like it was going out of style. Obviously, that was going to lead to inflation. Hell, we predicted that before it even started. But all the moron media outlets, they couldn't see it. You know, they're right back and telling us that everything's golden, it's good, and we need this money. Anyway, it was printed because of the poor decisions that government made by locking us all down. I don't care if that causes me to lose some friends because I'm going to speak the truth, guys. This is the truth, and I hope we never have to live through that again. That was the worst experience that we could have ever had in our country and around the world, by the hyper media causing everybody to lose their mind, including all the elected officials who couldn't go out on their own because it was a tribalism thing. It was, if you dared speak up against what their strategy was and what their official policy was, you were canceled. You were gone. You were shut down. You were removed from your platform. You were removed from your job, et cetera, et cetera, et cetera. So anybody who doesn't have their eyes open enough to realize what happened during that period, I hope you stop and think for a while about what went on. I went off on a tangent, but that's
well, we increased our M2 money supply in that time period to an all-time high.
That's what it was.
Basically, what that means is just the money that's circulating in the system. And when you have that many dollars in the system, of course, they're going to be worth less. So then that leads to this inflationary environment, peaked out at like 9.1% inflation. And I think people forgot, like, everyone wants to blame it on tariffs. I don't blame it on tariffs. I blame it on that situation that had. So now the Fed is trying to combat that, and they're late to the party, but it's caused a rally in gold because the dollar is so weak.
Because why is the dollar weak? Because there's too many dollars that were printed, and people are now skeptical of the dollar for that very reason. So they think, well, gold is going to keep a store of value. Also, people are using the same idea, the same rationale to buy Bitcoin and to put their dollars in what they consider to be an asset digitally, something that you can't touch, feel, or see. But so many people have adopted it that it's now become kind of mainstream, widespread. I'm curious what's going to happen though if shit hits the fan and we have a major recession or a major collapse in some area of our economy. I'm curious to see would people still believe in that concept, or will they revert back to
high risk
the good old greenback?
Typically get slaughtered in those type of scenarios.
When you're believing in something and everybody's saying, hey, look, I want to make sure I have my hands on cash. I don't know. I do know that there's a lot of people that are in the underworld that are kind of criminal behavior that like that because they can't be tracked or traced in what they're doing with it. So I don't know. Time will tell. I've never been a big fan of that, but this gold thing, that's the reason why it's hitting these all-time highs is because of the fear trade and because of what's happened with inflation and the lack of trust in the dollar. And a lot of the new generation, of course, I told you about the new message boards and people talking about the Federal Reserve, and they're hating the system and the government controlling the money, and they don't trust the government. A lot of people, the younger generation, it's funny, they don't trust the government in certain capacities, but they trust them with their life in others. Again, take that for what you want, but this is the gold market. We don't necessarily advocate it. It doesn't do what a lot of people think. It doesn't provide you an income. It doesn't grow. It doesn't produce anything. It's essentially there that you can hold on to it and then hope to trade it to somebody else to get your money.
And over the last, since 2007, the S&P 500 has handedly outperformed gold.
Well, and if you go back even further, if we had a chart going all the way back to 1929 or in the early 1900s, you'd realize it was not even on the same map as far as ending performance.
Sure.
So yeah, it can be positive in a short period of time when people are nervous. And speaking of nervousness, I fully believe that's a positive thing for the outlook on the markets. Because when people have a little bit of skepticism and they're nervous about the outlook and they're not willing to invest, that gives me comfort knowing that we're not at all-time highs yet. We're not at, I mean, all-time highs is a relative term. I mean, all-time highs from the standpoint of going into a major recession or correction.
When it's euphoric and everybody's calling us, I want to buy this stock, I want to get in. That is when we start thinking, hey, things are maybe getting way, way too stretched.
So, yeah, we talk about recession fears, bubble. You're hearing these terms come up quite a bit. Valuations in some companies are pretty high. I mean, we don't ignore that fact. We're watching, you know, and a lot of companies in our portfolios have stretched valuations. That doesn't tell us run out and sell them, because their earnings can continue to grow and they could grow into those valuations. We think sometimes it's good to have a period of just stability and not so much growing 20-30% every year on their price, but maybe growing internally on their earnings, and then just let the stock just catch up.
Sure.
So we're not going to bail out. We're not selling all these unless something tells us that, hey, earnings are probably going to tip over and go down. Then we're going to start thinking, all right, we need to trim back. We have to consider taxes. We have to consider the risk tolerance in everybody's account. There's a lot more to it than just saying get out because it's at an all-time high. So I hope you guys have got something out of this video today. We're watching it. We'd love to have you call us if you have some questions.
Appreciate your time. Thank you.
Take care, everybody.